in tradition.
Let Cora keep my ground so clean.
The heart and soul of the Cayman people. Thank you for keeping the culture alive.
Let's spread the news every day. From East End to Georgetown, down into West Bay.
Radio Cayman in the Cayman Islands. Money Sense is brought to you by the Chamber Pension Plan. For further information, visit the Cayman Islands Chamber of Commerce Pension Plan. We're here for you. We are a not-for-profit, member-centric plan with a democratically elected volunteer board of trustees representing all sectors of the Cayman Islands economy. We have an all-in expense ratio of less than 1%, over 20,000 members, and $490 million in assets under management. We were the first multi-employer pension plan approved by the regulator in the late 1990s, and today we are still strong, secure, and are here for our employees and employers alike. If you would like to join or require further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry, and I have the distinct pleasure of hosting this morning's show with my esteemed and intrepid co-host, Adam Newman. Good morning, Adam.
Good morning, Simon.
Well, how are you this morning? I hope that the muscles, the tendons, the joints, and other parts of the body are suitably recovered and soothed after your recent exertions. For those who don't understand and are bamboozled by this line of questioning, Adam has recently completed, after competing in the Cayman Islands Triathlon, and your position was?
In the half marathon.
Sorry, in the half marathon.
Was third.
Third?
Behind a couple of youngsters.
Oh, I was hoping Money Sense was going to have a winner in its ranks, but third. No, I'm kidding. That's pretty damn good. So it was all fun, was it?
It was very good. And then last week was the triathlon, which was great. And then onto new things, which is the Cross Island, which there's even rumours that Simon will also be joining and getting a team together for the Cross Island relay in a few weeks' time.
There is a rumour of that. I think you started this morning, in fact. Yes. Well, thanks for that. Yes. Well, this morning's show is going to be a very interesting show and very apposite given where we are in the world today. So we live in a world of almost zero interest rates, nominal interest rates. Indeed, we have done for a number of years. We live in a world of massive monetary activity by central banks. Indeed, we have had that now for a number of years. We live in a world of increasing indebtedness. Indeed, once upon a time, such levels of indebtedness would have been considered outrageous and would have sparked crises of currencies, would have sparked crises of governments. And yet here we are today, where all that is accompanied by record high stock markets, relative peace and tranquility. So how on earth does that reconcile? How on earth do those facts reconcile into one box? And what's that got to do with commodities? So that's my little intro for you, and you can take it away with an introductory narrative, and then we can get into some of the nitty stuff about the subject matter.
Perfect. That sounds great. Just one thing before we start. It wouldn't be Money Sense if we didn't mention my mother on this on this show.
Indeed. She's not in jail, is she?
So the great news. First, it's her birthday today.
Oh,
so
well, happy birthday,
Happy
Adam's
birthday,
mother.
Mum.
What's her name?
Ray.
Ray.
Right. And secondly, today is her first day of freedom. So sadly, she's probably not listening to this show. She's probably cavorting down the road, enjoying her new freedom.
For the first time, obviously, having been at home.
For the first time,
not
exactly.
behaving like Skylar did. Goodness me. Well, so she's a free lady today.
She is, as of today, on her birthday.
I was hoping, having bigged up your mother, that we would have swaths of England tuning in and swathes of... 7 Mile Beach tuning in as she's building up the audience for us.
But all we've probably done is lost a listener today. So,
well, happy birthday to Ray.
Excellent. Yeah. So, if we're turning to commodities, so just very quickly addressing your sort of comments around everything feels great. Mm-hmm. The stock market is doing really well, as you say. There's peace at the moment in the world, but I think below the surface there's more than a few ripples, and if we're not careful, things could start to deteriorate sort of socially and economically speaking, and we must always remember the stock market is not the economy and is not necessarily the real world. And a lot of the returns, one, have been driven by very lax monetary policy. And also a lot of the returns, and this brings me on to commodities, a lot of the returns in the last decade, or certainly the last 5 years, have been very concentrated in a handful of stocks, mainly US tech stocks. And so this broad, the recovery, or the at least perceived recovery, is not particularly broad-based, I'd say, at this point. But and commodities has been a painful sector to be investing in for actually probably more than the last decade. If you look at commodities in terms of their returns, and that's broadly speaking across the commodity complex, they've lagged the returns of things like the Nasdaq, the S&P 500.
But I think there's an interesting point you made, which is often really underlooked by a lot of people, which is, yes, the stock markets are at record levels. But you hit the nail, I think, really squarely on the head by saying it's not every stock that's at record levels. The index is made up and it's averaged and all the rest of it, but it's distorted by some really high-performing large capitalization companies. And so you've got the index at record levels, but a large number of the subcomponents of it are nowhere close to, and in some cases are substantially below. And in some cases, many of those have dropped out, being replaced by more tech companies, which are showing valuations often based on nothing, no earnings and all the rest of it. So it is a slightly distorted market, and that leads people, I think, to, you look at the headlines and you say, well, stock markets are at high levels, unemployment's coming down despite the pandemic and all the rest of it, so that must mean things are good. But then you as you say, you see simmering below bubbles and waves and ripples of discontent, and that's where we want to get into with commodities, because they are often, I suppose, a signal, aren't they, of other things that are going on in the economy, because people don't go to the supermarket and buy the stuff in the supermarket unless there's stuff to put in the supermarket, agricultural products and all the rest of it. So let's continue this theme then.
So one further comment on that. In terms of the, I don't want to go too far into this, but passive investing, which effectively means you're not actively choosing the stocks, but you are buying indexes. The construct of that means it naturally pushes you into the winning stocks and pushes investors, because of the way the funds are constructed, and out of the losers. But that actually becomes a self-fulfilling cycle, so that the most successful stocks get more capital as more capital comes in, pushes them even higher, and therefore they become a greater weight of any index, and therefore command even further capital, and it just perpetuates itself. The converse of that is that the commodities don't receive a lot of this money because they've been underperforming, and so they have become a smaller and smaller part of index funds, and therefore the capital doesn't tend to flow there. So if we take a step back, commodities, there's kind of three broad commodity parts. The metals part, which is precious metals, your gold, your silver, industrial metals, which would also include silver, but copper. Then you have the energy complex, so oil, natural gas, and then you have the soft commodities, the agricultural commodities like coffee and wheat and corn. And they have very different drivers, particularly in different parts of the cycle, and so it's important to sort of distinguish between them. And generally, when we think about commodities, the commodities that get the most flows, the most money going into them, are in the energy complex, particularly in oil. Oil is clearly one of the biggest and most important commodities, and then the precious metals. And then soft commodities tend to be quite a small part of the commodity complex. But we were sort of talking about inflation earlier. So the commodities can be a big driver of inflation. And when times are good and when demand is strong, this can be a sign that the economy is doing well. And conversely, when demand is weak, then commodity prices tend to suffer. At the moment, we have seen, and I talked about this on previous shows, I was expecting commodity prices to do particularly well this year and next. They have done extremely well, from everything from wheat to cotton, corn. Oil's up, I think, from the lows, we even had a negative oil print, but up massively. But I would say this is not really a sign of economic health and growth that's driving this. This is more one, decades of underperformance, and two, some structural issues with supply chains, which has been exacerbated by COVID. So we've had a breakdown in supply chains, which means it is either less supply or more expensive to bring products to market.
And you say hasn't necessarily been a good signal. Let's just, if I can, just sort of tease out a little bit more on that, because if I'm understanding that correctly, you hear when you say a good signal would be globally people are spending more money, are perhaps driving more or flying more or increasing their level of activity. And as a result, manufacturers need to produce more, car companies need to produce more, train companies need to operate more, so there's more activity going on in the world. And as a result, one has to consume more of the underlying commodities in order to sustain that activity. So demand has driven the level of activity and therefore improved the prices. Whereas bad price increases, the converse would be not because of demand driven, but because there have been, as you mentioned, these supply fractures. So where it would have been easily able to, when one might easily have been able to plough a field of thousands of acres, now one can't, and therefore some product goes to waste, and therefore demand might be the same, but supply is restricted. So that's if I understand it correctly, the good and bad supply dynamics that we're talking about.
Completely, and oil was a great example that this was in demand destruction was huge when people stopped travelling around the world, goods stopped moving around the world, global trade collapsed. Now we've had a huge increase in oil prices from the lows, and this has been driven by a cutback in supply from OPEC. And so it's not a genuine demand-driven phenomenon. This is a supply-driven thing. But actually, because of the nature of some of the cutbacks and the very low oil prices, a lot of investment hasn't gone into oil, in extracting oil. And therefore, we may be in for a rude awakening when demand finally does pick up. We can't instantly supply, there isn't that excess supply to so we could
satiate the demand. We could start to see spiky movements in prices in commodities if and when demand does reappear, because as opposed to being able to produce an extra barrel or an extra 2 barrels, suddenly there becomes, yes, one field can produce an extra 1,000 barrels, but it may not be able to produce an extra 10,000 barrels, and all of a sudden there's 9,000 barrels that are needed but can't be produced, so price has to quite rapidly accelerate.
Absolutely. And then in terms of also like unwelcome inflation, for something which we didn't speak about at the beginning is, in terms of looking at things below the surface, inequality has never been greater through this cycle. And if you look at real wages have not kept pace with inflation. So although broadly inflation is relatively low, if your wages have not been going up, the price of, or your disposable income, the amount of money you have to spend on goods and services is actually probably relatively going down. And the poorest people are most exposed to basic commodity prices like food. So this is bad inflation, that your income has not kept pace with the price of goods, and the price of your basic goods you're shopping is actually gone up a lot. Mm-hmm. So you have less money to spend.
And in fact, I guess here in Cayman we've seen quite a good example of that, where supply constraints and disruptions have caused prices to go up quite a lot in supermarkets. A lot of people will anecdotally feel as though their weekly shop has gone up in price. And that's not because there's 20,000 more people in Cayman causing more demand. There simply aren't. We know for a fact there are fewer people. But it's because disruptions in the UK, disruptions in the US have caused difficulty getting products to the ports, getting difficulty getting it transported onto the ships, offloaded because people are falling ill, people are unable to go into work, and so that's caused this bad price increase. And then if your wages haven't increased as a result, you're naturally poorer because you're spending more but don't have as much in terms of earnings.
Exactly, and my view is we're still early in this cycle, so commodity inflation is actually going to start to erode people's disposable income even more in the future. We're still living with these supply disruptions, and as you say, as demand comes back, that's only going to exacerbate a problem that we're already seeing.
So, and your suspicion is that then, if demand starts to recover, we will see fairly aggressive moves in some or potentially all commodities as a result of the supply disruption that has been engineered almost into the system.
Yeah, I mean, in terms of all commodities, those that are demand-based, so, the industrial metals, not necessarily precious metals, they very different, but agricultural commodities, energy complex, yeah, I think that's quite likely.
Interesting. Well, look, we're going to take a quick break. After that, we're going to delve into some of the more nitty-gritty of some of the individual commodities, and also try and demystify some of the buzzwords or some of the complex words that come along with commodities. So join us again straight after this break.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Are you currently a member and interested in the management of your pension plan? If so, consider becoming a volunteer trustee. Becoming a trustee is a great way to play an integral role in the governance of your pension plan. If you'd like to learn more, email pensions@chamberpension.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Welcome back to Money Sense and our conversation with the ever erudite Adam Newman. In the first half, we wandered across the plains of the commodity landscape. In the second half, we're out to kill some of the big beasts of the commodity world, talking about some of the specific elements, metals, agricultural products and such like. But perhaps before we go into the nitty-gritty of it, why is inflation so relevant to commodity investors? We'll talk about what things people buy in a moment, but why is inflation the topic that needs to be slain before we can start to understand the underlying asset classes then?
I mean, inflation, I mean, we've been living in a period of very low inflation for an awful long time, which has allowed central banks to cut rates aggressively without consequences. You know, you cut rates to try and drive demand and hopefully see a pick up in inflation. But inflation has remained low for a very long time, and we can have good and bad inflation, as we were sort of talking about with commodities earlier. If inflation is being driven genuinely by demand, broad demand, and wage growth, then that can be a positive sign. If we start to see inflation being driven higher by problems with supply, and it's not a sort of demand-driven phenomenon, then we have problems because central banks may be forced to raise interest rates, which tends to dampen demand just to get on top of inflation. But that actually is, going to compound a problem when economic growth is slow. So
this is what happened during the late 70s in the with the oil crisis, where oil prices went up because of conflict issues, and yet central banks responded to this supply shock by raising interest rates and stalling the economies of most of the developed markets of the world. And that's obviously, central bankers and economists have the ability to learn from history, but we also often repeat the same mistakes that we've done.
Yeah, and we refer to that as stagflation, where we have inflation without economic growth. And I guess these are the unintended consequences. No one could properly foretell that we're going to have COVID, but COVID has exacerbated this, and now we've got potentially very unwelcome inflation in commodities.
Okay, well let's go into some of the individual elements, so to speak, of commodities. And one of the perhaps most germane questions to be asking is, how does someone actually invest in commodities? So laying the landscape whereby someone is listening to this and has listened to various shows and watched various TV shows of economics and finance and is worried about the risk of inflation accelerating, realizes that perhaps bonds under those environments are an extremely dangerous asset class to own, is nervous about the exposure of equities to earnings or lack thereof, and says, well, if inflation is increasing, it's because of raw material prices that are going up, and therefore commodities would seem to be a sensible place for me to consider investing. Well, how do they go about doing it? Because it's not as simple as going out and buying a bar of, it could be as simple as going out and buying a bar of gold, but where do you buy one from? A barrel of oil? Well, lovely, but what do you do with that? These are somewhat odd concepts. It's obvious what they are, but it's not always obvious how one invests in it. So let's go through some of the individual mechanisms.
Yeah, I mean the system is has evolved a lot, and both in terms of individuals' access to products has got much easier, much better and easier to get exposure, and also the complex of the actual instruments have evolved with that. So it is possible to effectively buy almost like a share of a commodity complex. So there are exchange traded funds, which we've talked about before, ETFs, which effectively replicate a exposure to underlying items, and they can be very specific. So you could have an ETF which is, effectively just buying gold, and it mirrors the price of gold. Or there are ETFs out there that effectively mirror the price moves in a broad commodity basket. And so I would say to someone who wants exposure to likely inflation in the commodity complex, rather than focus on individual commodities, buy an ETF which has exposure across all of the items, so soft commodities, industrial metals, and energy. And energy and industrial metals tend to be the biggest weights, and commodities maybe only sort of 10 to 15% of that exposure, but that's probably right, and I think you don't need to be any more sophisticated than that. For people who trade or understand investing a little bit more, then and have individual opinions on something like oil, it is quite easy to go and buy a future, which is effectively buying exposure to the future price of oil, but tends to closely mirror the price of oil. But there are, as we were speaking about earlier, some nuances and important things to understand when you're buying a future. In terms of delivery, we've talked about sort of the cost of rolling futures forward. So it can be quite expensive to get exposure to futures.
The future technically ends with no value unless you've done something with it. It's buying the price. It's the right to buy the price or to take delivery of something at a specified price. And you've got to do something with that commodity at that price, or you've got to settle it in the future. So you've got to be careful about how you expose yourself through these assets.
Exactly. So all futures have an expiry date at some point in the future, and they can be quite long dated. By that I mean, you're buying 1 year forward, so you're buying the price of oil in 1 year's time, or you can buy something with the price of oil in 1 week's time or a month's time. Just to
interrupt there, if I may, sorry. If someone thought that over the next 12 months there would be a pickup in industrial demand and that would cause oil prices to increase, they should be looking probably at buying a 1 year oil future as opposed to a 1 week, because the mechanism by which the oil price would increase may not happen in a week. It would likely happen over a slightly longer time in that sort of theory.
Absolutely, and it's far less costly to do that, to buy something long dated. And just because you're buying something 1 year in the future, you can settle it at any point. So the price moves, price will move throughout that time. It's dynamic. And so if it reaches a price that you're happy and you've profited from it, you can close that future very easily at any point in the time, so you're not literally tying yourself into that 1 year.
So if you are thinking about buying futures, you've got to be not just understanding what the underlying asset is, so you're not just got to understand what oil is and what might happen to its price, but you've also got to be mindful of the technicalities of the security you're buying. It has a specific date of maturity or of exercise, and so you've got to be mindful as to represent your intellectual view as to what will happen to the underlying, but make sure it's represented or representable by the actual security you're buying. So if you think in the next 12 months it's going to go up, don't buy something that matures in 1 week, because that's not going to do anything for you.
Absolutely, you need to match your investment horizon with the the time horizon of the actual instrument you're buying. And the other thing worth noting is as you get to expiry or on expiry, you either have the choice to close the position there and then, or you get the choice to roll, which means take on the next future date. It can be very expensive if the contract is in contango, which means future prices are more expensive than current spot prices. Current price today, to roll it will cost you money to roll on to the next contract. So it's not. I wouldn't say it's a hidden cost, but it's a cost that a lot of people wouldn't necessarily be aware of. So there are costs to rolling future contracts as well.
And so, in other words, you may not be able to get as much of the next contract as you originally had of the first for the same amount of money.
Correct. Okay. Which again, why if you can got a long dated view, it's useful to try and buy something as far out as you can.
Something with a longer view might cost you a little bit more up front, rather than something so short. There might be a risk of that, but you want to set that against the risk of something happening in a week versus happening in a year, I suppose.
Absolutely, 100%.
And what other ways are there of it? People could buy options, I suppose. That's another avenue. But go on. I see you grimacing.
No, I mean options, can present huge opportunities, 5-10 times your money, but they come with risks. You're basically making a bet or having the opportunity to buy the option to buy something further down the line, but because of the way they're priced, the price move is exponential on the way up and down. Just because if you have a 1% price move in the underlying, you will have a far greater move in the actual option price. And this is to do with sort of time decay and the way you price options. So unless you're very comfortable and understand that, I would say it's probably not for most people. You basically pay a premium like an insurance. If the bet goes your way, you can make a lot of money, and if you lose, you will lose just your premium. So it's quite nice that you can have understand your exact downside, i.e. your premium, your insurance, and the upside can be huge. And there are a lot of platforms out there who will actually really help and educate you on how to do these options, but it's really not for...
Be careful.
Yes.
So there's another aspect of commodity investing which is always, I think, puzzled, perhaps it might be the right word, a lot of people, which is if I go and buy a share in General Electric or I go and buy a share in Google, they're doing something with the money. They're creating economic activity. If I go and buy a unit of an ETF that's holding oil, and the oil price today is $50, and in a year's time it's $50, my oil ETF probably won't be worth the same today. Sorry, the same in a year's time as I bought it to today, because physically you've had to hold the underlying asset or you've had to do something. So it's not quite as easy an investment proposition as it might be buying into a company which is producing stuff, because you've actually got to physically hold the underlying asset in order. So if you buy a unit of gold, you've got to store it. So there's costs associated with that. So it's not quite as straightforward as comparing with the equivalent of buying shares. It does these things do, all other things being equal, degrade over time in terms of the price of them.
Yeah, and that's why we talk about looking at the forward curve and the shape of the forward curve, which is the price out into the future. And when you have a forward curve which is in contango, where the future price is more expensive than the spot, generally for a lot of commodities, that is taking into account of storage costs, insurance costs. So you would naturally expect the future price of gold to be more than the price of spot. Naturally, all things being considered, because you have to add on storage, insurance costs and stuff. So there's hidden costs that not necessarily obvious to most, which can actually erode your profits.
And there's no, as there is often with ETFs of regular companies, there's no income stream. So there's no dividend you're getting from, I can't think of any commodity that would pay a dividend stream as such.
Correct.
So you're not going to get that. It's purely, your only exposure is to the price movement in the future.
Yes.
Which changes the risk profile slightly as well. So if somebody the person who's listening to this says, okay, I'm interested in the commodity space, where are you more keen, Adam, as an investor? You've mentioned the different elements. You've got the metals, you've got the soft, you've got the precious, industrial. Where do you think the greater opportunity is, and why? Just in our last 60 seconds.
I've spoken about this a few times. So I like the soft commodity space because
the food stuff,
so coffee, cocoa, wheat, corn. Why? Because it's less understood, which presents opportunities. Less efficient markets, I believe, for the average person. It's also much more nuanced than energy is, or oil is a huge global trade. It's about understanding the whole global macro, whereas
there's huge traders from Exxon, BP, Shell who are all trading in that every single day.
Exactly. And coffee is actually one of the most traded commodities in the world, but it helps. So 40% of all coffee is produced in Brazil. So it's, for me, I've looked at Latin America and Brazil for a long time, so I understand well about what's going on in Brazil, and that matters a lot. The price, the value of or the FX rate of the Brazilian real feeds into the price of coffee and stuff. And so for me, it's sort of more nuanced, and also the supply disruptions that can happen from one country are far greater than if you're spreading oil production over the whole of the world. So I also think where we are in the cycle, food and soft commodities have been the most, have underperformed the most over time. And so I think the opportunities now going forward are the greatest. So for me, it's coffee, and I like soybeans as well.
Fair enough. Well, that's, and if I'm putting you ever so slightly on the spot, I know we're wrapping up imminently, but you do write a lot about this, and quite a lot of your research and your thoughts you post on Twitter, if I'm not mistaken. And I'm going to get it wrong. At 1,000 feet.
At from underscore 10,000 feet.
10,000 feet. Sorry. Okay, so say that again.
At from underscore 10,000 feet.
At from underscore 10,000 feet. Got you. So go there to find out a bit more about Adam's research and thinking and thoughts, because there's a lot of writing that you've done on it, and it's very interesting stuff as well. So I'd encourage people, if you want to learn a little bit more about commodities, that's a great place to just to get into it and get into the nitty gritty of it. Adam, thank you very much for joining us. We've run out of time, barely halfway through the topic that we wanted to get through. I hope you enjoyed yourself, and that you'll suffer the trials and tribulations of rejoining us one day again in the future.
Perfect.
Now, as a final note then, before we leave, just thank again all our listeners, including Adam's mother, and happy birthday once again. I remind you that today's show will be available as a podcast on the CFA Society Cayman Islands webpage. I encourage you, if you have a question or topic, do email us at moneysense@candw.ky or tweet us at Moneysense Radio. With that, thank you once again. Goodbye, and do tune in 2 weeks' time.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Are you aware of the performance of your pension plan? The Chamber of Commerce Pension Plan provides quarterly fund fact sheets for our members to stay informed with the plan's performance. For the year ended August 31st, various life cycle funds provided returns between 9.2% and 16.5%, and our all-in expense ratio is currently the lowest it's ever been, a record low at 0.72%. Visit chamberpension.ky to review our fund fact sheets. You can see the performance as far back as 10 years. Remember that pensions are a longer-term investment strategy. Focus on the long term rather than the short-term returns. The Cayman Islands Chamber of Commerce Pension Plan continues to perform for you.